All right, let's just get right to it. It's the question on everyone's mind right now, right? You see stocks like Nvidia just going through the roof, and you have to wonder, is this for real? Are we in the middle of a genuine tech revolution, or are we all just floating in a giant AI-fueled bubble? Well, to get some real answers, we're going to dig into what legendary investor Ray Dalio has to say about it.
And let me tell you, he does not pull any punches. When he was asked straight up, are we in an AI bubble? His answer was a clear, unambiguous yes. But hold on, before you go and hit the sell button on your entire portfolio, you really need to hear why he thinks that. His reasoning is a whole lot deeper than just a scary headline.
Okay, so to really get inside his head on this, we've got to start with the basics.
Yeah, I mean, what is a bubble anyway? It seems like a simple question, doesn't it? But according to Dalio, the way most of us think about it, we're missing the most critical piece of the puzzle. So let's break down how he sees it. This definition is the key to everything.
You see, for Dalio, a bubble isn't about hype or excitement or even just crazy high prices. It's something much more, well, mechanical. He calls it an unsustained set of circumstances. That means the amount of buying happening and the valuations we're seeing, they just can't keep going. That word, unsustained, that's everything.
And this is a really important difference. You know, most of us think a bubble is about people getting way too optimistic about future earnings. We think it's a bet on the future. Dalio says, nope, that's not it. For him, it's all about the raw mechanics of the market today. It comes down to a very simple question. Who needs cash and when are they going to need it? It's a tug of war between buyers and sellers, not some pie-in-the-sky guess about what's to come.
So how does he actually spot these unsustainable situations? Well, he looks at who's holding the bag. He splits everyone into two camps. You've got weak hands. Think about regular folks who've borrowed money to invest. They're leveraged up. Then you have strong hands. These are the company insiders, the founders, people investing their own cash. And believe me, knowing who holds the assets, the leveraged versus the unleveraged, is absolutely central to his entire analysis.
All right, so now that we have his framework, let's apply it. How does today's market look through his eyes?
And look, this isn't just him getting a bad feeling. He and his team have built a literal bubble indicator. It tracks all these things we've been talking about, leverage, who owns what, and it's packed with data that goes all the way back to the year 1900. This is a serious, systematic, data-first approach.
So what's that indicator saying right now? What's the reading on the dashboard? It's flashing this, 80%. According to his metrics, we are 80% of the way to a classic top-of-the-market bubble. Now, to put that 80% number in perspective, just think about this. Let's say the biggest, most famous bubbles in history. We're talking the 1929 crash and the dot-com bust. Let's call those a perfect 100 on the scale. Well, right now, we're sitting at an 80. That means we are in some very, very thin air, historically speaking. It's a dangerous place to be. Okay, this leads to the next huge question. Because according to Dalio, bubbles don't just, gently deflate on their own. Something has to come along and pop them.
And here's his main point again, and it's so important. Forget about a company missing its earnings for a quarter. That's not what does it. Dalio is convinced bubbles burst for one very simple, very mechanical reason. A whole bunch of people suddenly need cash, all at the same time. And when they're forced to sell their stocks to get that cash, that's when the whole house of cards comes tumbling down.
It's like a domino effect, right? First, something comes along to prick the bubble. Dalio says it could be something like the Fed suddenly tightening up money, or maybe a new tax gets passed. Whatever it is, that event suddenly makes people need cash. And how do they get it? They have to sell their assets. That forced selling creates this wave of more selling, and that downward spiral, that's the pop.
So, okay, we're 80% of the way there, just waiting for something to prick the bubble. This leaves you, me, every investor out there with one massive question. What in the world do you do now?
And this is where it gets really interesting. Because if you think the logical next step is to sell everything and run for the hills, think again. Dalio's advice is the exact opposite of what you'd expect. He actually says, and I quote, "Don't sell just because there's a bubble."
And why on earth would he say that? Well, because timing is everything, and getting it right is almost impossible. He tells this great story about Charles Merrill, the Merrill from Merrill Lynch. Back in early 1928, he saw the bubble forming and told all his clients to get out. And you know what? He was right, eventually. The thing is, the market kept going up, another 90%, before it finally crashed in late 1929. So yeah, he was right, but being that early meant missing out on a mind-blowing rally.
And that right there is the huge dilemma every investor is facing. In the short term, this party could keep going. The bubble could get even bigger. But if you look at the long term, the data is pretty sobering. Historically, when markets get to these levels, the returns over the next 10 years are just blah. We're talking somewhere between a measly plus 2% and a negative 2% per year.
So that's where Dalio's analysis leaves us. From his point of view, the debate is pretty much over. It's a bubble, which means the really important question isn't if it's a bubble anymore. The question you and I should be asking is, what's going to be the pin that pops it?